What if I told you that gold, the metal considered humanity's oldest store of value, has just lived through one of its darkest days? On September 13th, 2025, more than a dozen gold dealers suddenly vanished from China's largest wholesale gold market in Shenzhen. Reports estimated that the losses exceeded 100 million yuan, according to data published by China Finance Online in September 2025. Chaos swept through the district. Storefronts closed, merchants fled, and rumors spread that at least 20 companies had collapsed in a matter of hours. Welcome to Telnomics, the channel that connects numbers, power, and geopolitics to reveal how economic crises shape the destiny of entire nations. The pressing question is, how can a market that handles about 65% of China's national jewelry production, according to the Shenzhen Jewelry Association, collapse so abruptly? Gold has always been linked to stability, a hedge against crises, and a safe haven asset for investors worldwide. The World Gold Council reported that in August 2025, global reserves surpassed 36,000 metric tons, with central banks increasing purchases to shield themselves from currency instability. Yet, in Shenzhen, that same gold stopped symbolizing security and instead became synonymous with panic. But the tragedy was not just in cold numbers. Small traders who depended on every gram sold saw their savings evaporate in days. Imagine a family entrusting their life savings to a local gold dealer, confident in the centuries-old tradition of gold, only to find out that the merchant had disappeared with tons of undelivered metal. Isn't this the most devastating form of broken trust? What makes it even more striking is that this collapse happened at a time of soaring global demand. According to the London Bullion Market Association, gold prices climbed above 830 yuan per gram in September 2025, one of the highest levels in a decade. How is it possible that during such historic appreciation, China's largest gold hub imploded? This is just the beginning of an investigation that goes far beyond numbers and transactions. We are facing a business model that turned into a high-stakes gamble, where greed, speculation, and structural weakness walked hand in hand. And the question remains, when gold turns into a casino, who really wins? Behind the scenes in Shenzhen, traders were not merely selling gold. They were betting against the very future of the world's most precious metal. The hidden risk in the business. Have you ever imagined buying gold to protect yourself from crises, only to discover that the dealer had actually bet against the very value of the metal? That is exactly what happened in Shenzhen. Many dealers stopped relying on modest refining fees and instead plunged into dangerous speculation. According to the China Gold Association, in September 2025, the spot price of gold hovered around 820 yuan per gram. To attract customers, some sellers offered lower prices, such as 810 yuan per gram. Clients paid up front for large quantities, but the dealers did not immediately purchase the gold. Instead, they gambled that the price would drop to 790 yuan per gram, securing a profit of 20 yuan per gram. But reality turned against them. The international market surged. The World Gold Council recorded a sharp spike that pushed domestic prices above 830 yuan per gram in mid-September 2025. The outcome? Instead of profiting, dealers were forced to buy at higher prices and deliver to customers at the lower, already agreed price. Losses multiplied rapidly, and when hundreds of kilograms are involved, this is not about minor setbacks. It means tens or even hundreds of millions of yuan. For many, the only escape was to vanish. This dynamic exposes a micro-conflict you may have experienced on a smaller scale, trusting someone who promises more than they should. How many times have you seen offers that seemed too good to be true? In the gold trade, that trap cost fortunes. Imagine paying upfront for jewelry that would never be delivered, while the dealer disappeared in the middle of the storm. This was not just speculation. It was the transformation of an entire sector into a financial game of Russian roulette. And the inevitable question arises, where were the safeguards? The People's Bank of China had already issued measures back in 2018, banning non-financial companies from offering gold accumulation services. Yet in practice, many traders exploited loopholes, disguising financial bets as physical gold sales. The fault, therefore, was not only in the dealers, but in a system incapable of containing risk. This scenario should serve as a warning. After all, if a market as traditional as gold can morph into a casino, what does that reveal about other sectors where we place our trust every day? If you want to follow this investigation and understand how this collapse could reshape the future of the global economy, subscribe now to Telnomics, activate notifications, and leave a like. Your participation helps spread this content to more people who need to uncover the hidden risks behind seemingly safe promises. The Golden Casino of Shenzhen. Imagine discovering that the gold you paid for upfront never even existed. That is exactly what thousands of customers in Shenzhen faced. Reports published by Southern Finance in September 2025 revealed that many dealers did not actually hold gold in stock. The model was simple. They collected full payments, created digital reserves in apps, and instead of delivering the metal, asked clients to wait a few more days. In that window of time, they gambled on price fluctuations. But what if prices did not fall? The outcome was inevitable, a snowball of debts and a mass flight of merchants. And here comes the uncomfortable question. How could a sector responsible for about 65% of national jewelry production, according to the Shenzhen Jewelry Association, be sustained on something so fragile? For some experts, the answer lies in the absence of written contracts and an over-reliance on personal trust. It was like a rigged card game, where verbal promises counted more than legal guarantees. But in a billion-dollar market, trust can be bought or betrayed in seconds. A parallel to everyday life may help illustrate this. Think of paying upfront for a house before it is built, relying only on the builder's word. And what if the construction never gets completed? In the case of gold, the losses were not only financial. Trust, one of the most vital pillars of any market, was shattered. When customers discovered the vaults were empty, all that remained were police reports and shuttered storefronts. World Gold Council data showed that in September 2025, gold had gained more than 12% in value compared to the start of the year. Such a scenario should have meant prosperity for dealers, but instead, it revealed a brutal contradiction. The higher gold climbed, the harder it became for traders to honor commitments made through reckless bets. What should have been an opportunity turned into catastrophe. And here lies the breaking point few predicted. A sector that seemed solid was in fact dependent on practices resembling a casino disguised as a wholesale market. It is no exaggeration to say that Shenzhen, for a few days, lived through the collapse of a golden empire. But if this was only the epicenter, what would happen once the wave of bankruptcies spread across the country? What looked like a problem confined to Shenzhen quickly became the spark of a nationwide domino effect, dragging merchants from north to south. With each new bankruptcy, China began asking itself, how deep does the fragility of a market everyone once believed to be indestructible truly run? The contagion. Across the country. When Shenzhen's vaults began to empty, the crisis stopped being an isolated rumor and turned into a wave of bankruptcies spreading across China. In Changsha, Hunan province, the case of trader Tong Jing dominated the headlines. Owner of one of the region's largest gold recycling platforms, he vanished, leaving behind debts exceeding 200 million yuan, according to records released by the China Business Journal in August 2025. Small shop owners who had handed over their gold in trust, expecting payment later, were left empty-handed. Many said they had lost their entire life savings. Once again, confidence had turned to dust. Tragic stories surfaced in city after city. In Yuyang, also in Hunan, desperate dealers tried selling dozens of kilos of recycled gold at discounts of 3 yuan below market price just to get immediate liquidity. Nobody wants gold now, one merchant confessed to Caixin Global in September 2025, exposing the depth of despair sweeping the sector. In Hanzhou, a store owner announced that after liquidating just over 700 grams of gold, he would shut down permanently. The atmosphere of surrender contrasted sharply with the prosperity the Chinese jewelry market had long projected. The micro-conflict was clear. On one side, families trying to sell their gold as a last financial lifeline. On the other, traders unable to find buyers willing to take the risk. In a country where gold is not only an investment but also a cultural tradition, the idea that nobody wants gold now carried a symbolic sense of collapse. With every store that closed, a new unsettling question arose. If even gold lost its aura of security, what remains to protect ordinary people's wealth? According to the World Gold Council, China leads global demand for gold, accounting for around 30% of world consumption in 2024. This means that instability in the Chinese domestic market directly impacts international supply and prices. In other words, this was not just a local crisis, but a threat capable of shaking confidence in gold as a safe haven asset worldwide. The collapse in Changsha and in so many other cities exposed an uncomfortable truth. Gold had ceased to be a refuge and had turned into a risk. But what came next would reveal that beyond bankruptcies, there were also far more sophisticated schemes hidden behind promises of easy profits. Golden pyramids. If the collapse in Changsha and Shenzhen seemed severe, the scams that followed proved the problem went far beyond mismanagement. It was fraud on an industrial scale. A striking example was the platform DGCX Xingkongja, which promised daily returns of 1 to 2% on gold and cryptocurrency investments. According to the South China Morning Post in July 2025, more than 2 million people were lured into the scheme, which moved nearly 13 billion yuan before collapsing. The script included fake videos of signed contracts, alleged ties to the Dubai Gold and Commodities Exchange, and even promises of oil-backed projects. In reality, it was nothing more than a highly sophisticated Ponzi scheme. For many ordinary investors, it appeared to be a safe bet. Who has not felt tempted by promises of stable returns in uncertain times? The platform branded itself as state-backed, used technical jargon to create a false aura of legitimacy, and even encouraged users to take out loans to increase their positions. One of the most dramatic testimonies came from an investor in Guangdong province, who told Caixin he lost 90% of the savings accumulated over years of work. "They laughed at our naivety while fleeing abroad," he said, describing the sense of helplessness as authorities reacted too slowly. And this was not an isolated case. In Hanzhou, Yongkun Gold Jewelry, presented as a full-service gold provider, collapsed in 2024, leaving more than 12,000 investors in the red, with losses estimated at 4 billion yuan, according to Xinhua News. The disturbing detail: many of these schemes were led by the same business groups, who launched new companies after each bankruptcy, targeting victims in different regions. The pattern repeated mercilessly. Each time a fraud was exposed, crowds of investors gathered outside company offices, often dispersed by police. Entire families lost everything, from retirement savings to education funds for their children. The social impact was as profound as the financial destruction. These scams did more than wipe out fortunes. They eroded collective trust. What is most disturbing is that the next scandals would reveal something even darker. Even traditional financial institutions were entangled in frauds that further undermined faith in gold as a safe haven. The bank's fake gold. And what if even the bank you trust turned out to be part of the problem? That is exactly what happened in September 2025, when a customer in Shanghai brought a gold bar purchased from the Industrial and Commercial Bank of China, the world's largest bank by assets, according to Forbes Global 2000, to be melted into jewelry. When the bar was tested, it turned out to be a counterfeit, likely made of tungsten, a metal almost identical in weight to gold. The complaint, captured on video and published by the Shanghai Observer, forced the bank to acknowledge the error after the customer presented the serial number corresponding to official records. This was not an isolated case. Caixin Global reported similar incidents at other branches in recent years, raising suspicions that large-scale fraud was being disguised as isolated mistakes. How can people trust a system where even the most reliable link, the bank, can be called into question? This revelation exposed an even more unsettling truth. If consumers cannot distinguish between real gold and adulterated bars, then the entire concept of store of value collapses. The micro-conflict becomes sharper when we think about everyday life. How many people keep small bars or jewelry as savings for emergencies, believing they are protected? Now imagine discovering, at the moment of greatest need, that the asset you counted on is nothing but fake metal. The frustration and despair turn into disillusionment, not only with financial institutions, but with gold itself. Meanwhile, gold prices remained volatile. According to the Shanghai Gold Exchange, on September 16, 2025, gold reached 837 yuan per gram, a sharp increase from the 769 yuan recorded in May of the same year. Rising prices should have reinforced confidence, but instead, they deepened the perception that every spike only magnified risks for investors and traders alike. The dilemma is clear. If even bank-issued gold cannot be trusted, what remains solid in this market? The crisis was no longer merely economic, it became existential. What happens when the cornerstone of global financial security turns into a symbol of fraud? At this stage, the issue was no longer about merchants or banks. The real collapse was striking at the heart of society itself: trust. And once trust breaks, it is not only gold that loses value, it is the entire network of relationships that sustains community life. The collapse of trust. For centuries, gold has been synonymous with stability. Kings, empires, and governments stockpiled bars and vaults as proof of strength. But what we see today in China is the opposite, a crisis of trust that spread from Shenzhen's jewelry stores to the country's largest banks. It is not just the metal that is in question, but the invisible bond that connects economies, institutions, and ordinary people: credibility. According to the World Gold Council, global demand for gold rose by more than 10% in 2024. Yet in China, paradoxically, a wave of frauds and collapses turned this gold rush into widespread distrust. The problem does not lie only with reckless traders or Ponzi schemes promising impossible returns. It runs deeper, exposing the fragility of regulation. Caixin Global highlighted in September 2025 that local authorities often acted too slowly, sometimes even shielding collapsing companies rather than protecting investors. This complicity created fertile ground for increasingly elaborate scams, with platform leaders fleeing abroad before regulators could intervene. The result was devastating, a crisis that undermined trust not only in gold, but in the financial system itself. And the social consequences are just as corrosive. Friends, relatives, and colleagues who once recommended investments to each other are now breaking ties amid accusations. Small communities saw relationships unravel because safe gold turned into debt, and protection turned into a trap. Analysts such as Xi, interviewed by the Financial Times, warn that we are witnessing a collapse of trust with a social impact comparable to that of a systemic banking crisis. What can be done in the face of such a scenario? Experts recommend extreme caution. Never trust promises of guaranteed returns. Always demand official certification and diversify investments. The People's Bank of China has issued measures since 2018 prohibiting non-financial companies from offering gold accumulation services. But supervision must be continuous, with exemplary punishments to restore credibility. This is not just a warning for China, but for the entire world. If even gold, long considered humanity's safest reserve, can be manipulated and counterfeited, then no asset is truly free of risk. Real protection may not lie in the metal itself, but in the ability to build transparent systems, trustworthy institutions, and a vigilant society. If you want to continue uncovering how hidden crises shape the global economy, subscribe to Telnomics, like this video, and leave your comment. Your voice is essential to broaden this debate. Thank you for staying with us until the end. Gold may lose its shine, but knowledge remains the most valuable asset we have.